Hey guys, Sean here with Everything REI, and today we're going to talk about everything to do with hard money loans coming right up. So what are hard money loans? A hard money loan is a short-term loan that many flippers use to be able to get in and out of projects while leveraging the most they can on a particular project. Most hard money loans are for only 3 to 4 months. They have very high interest rates compared to a traditional 30-year amortized mortgage, but they're used because they allow you to leverage and they allow you to purchase properties that normally you could not afford. For example, most properties here in the Bay Area go for at least $1 million, and most people just don't have $1 million in cash. And if they were to go through a traditional route of getting a long-term mortgage, it would take over a month to close escrow. Most of these deals are only possible because the sellers are in some kind of financial distress and the buyer is able to close quickly on these deals. Being able to use a hard money loan allows you to purchase a property and close within 10 to 15 days, whereas a traditional loan can sometimes take over 30 days. So what I wanted to do today is kind of break down what a hard money loan is and what are the common terms that they use. So if you're a brand new investor and it's your first time getting a hard money loan, then this video is right for you. Typically, if you're brand new, then you probably can't get as much leverage as an experienced investor can. So you're looking at getting things at 85% LTV or 90% LTV at the best. And what does that mean? It means that your loan to value ratio is either 85% or 90%. So if you have $1 million property, then the max that someone will loan you is either $850,000 for 85% LTV or $900,000 if it's 90% LTV. Now, what does it cost to get a hard money loan? Well, for a brand new investor, you're typically going to see rates at 10% annualized and 2 points for the origination. Now, what does that mean? That means for your $900,000 loan, 10% of that $900,000 is due every year at an annualized rate. So after holding that loan for a whole year, you will have paid $90,000 in interest payments. And yes, that sounds crazy, but it's worth it if you're going to make $200,000 on the back end. Now, what are origination fees? Origination fees are the fees that the hard money lender charges you to originate the loan. And what does that mean, originate? It means to create the loan for you. They have people in the back offices underwriting the loan, salespeople who are creating the loan packages for you, and working with you to close on time. That all costs money. These are hard money lenders, and that's their main bread and butter for their businesses. They get commissions for every origination that they produce. Most of them are 2% for new investors. So for a $900,000 loan on a $1 million property and 2% origination fees, you're going to be paying $18,000 just to close on the loan. But they don't actually charge you $18,000. What they actually do is they just give you a smaller loan. So instead of giving you that $900,000 loan that you were expecting, they're going to give you a loan for $882,000. And then they'll just say that you owe them $900,000 on the back end. Usually what that means is that you have to come up with more money to close on the property in the first place. So when you come to the closing table, what kind of funds do they need you to have? Obviously, they want you to have the 10% or 15% as the down payment for the property, but you also have to have enough liquid capital to pay for the origination fees. You also have to have enough money to pay for all other buyer closing costs, like notary fees, title fees, and other miscellaneous stuff that they charge you when you close property. When you get your hard money loan, you also have to be careful if they have a prepayment penalty. Sometimes they'll charge you 4 months of payments regardless if you close in 1 or 2 months. So some people, they do something called wholetailing, where they buy a property with hard money and they put it back on the market without doing anything and they sell it within 1 month. Well, if you have a loan that has a 4-month minimum, then you have to pay those 4 months worth of interest payments no matter what. So just be careful when you're getting a loan to make sure that there's no prepayment penalty, or if there is, that it doesn't affect you because you're going to spend a long time working on that project anyways. When you're getting a hard money loan, you also have the option of getting a construction loan. A construction loan is funds that the hard money lender will lend to you in order to do the actual project. So for a $1 million property, if you're going to spend $100,000 into it, obviously you could have the cash and you could just do the work yourself, or you can ask for a construction loan. Now, construction loans on hard money loans are a little bit different because they don't just give you $100,000 for you to go play with. What they do is they hold $100,000 in their bank accounts and they give it back to you as a reimbursement. They do something called draws. When you go get a hard money loan, you provide a scope of work. You tell them what you're going to do to the project and how much each line item will cost and what phase you'll be doing it in. And you can ask for 1, 2, 3, or 4 different draws. Now, draws are interesting because you have to go in there, do the work first, and then you get reimbursed for that money. Say you have 4 different draws, each one $25,000 worth. You have to show to your hard money lender that you completed that first quarter of your project, have them send an inspector in to look and make sure that all that work is done, and then they'll pay you $25,000. Construction loans are a little bit crazy too, because some companies, they charge you construction loans on day one, even though you don't actually get that money on day one. What does that mean? It means that when you're getting your loan, you're still gonna have to pay that 10% annualized rate and 2 points on that $100,000, even though you're not getting that money on day one. That's why personally, I don't get construction loans if I can help it. I think they're kind of a waste of money, and I'd rather just have that liquid capital so I can do whatever I want without having to rely on them to fund my deal. Because let's say that you have an inspection done and the inspector doesn't agree that you did the work, well, now you're out of your pocket and you need to fix the work with money that you may not have because you're over leveraged. Versus if I had the capital in cash, I could just fix it myself. And yeah, the worst part again is that they charge you on day one. So let's say you get your loan on January 1st. They're gonna charge you that 10% interest on your $100,000, even though you might not even get your draws until March or April, which is crazy. Now there's a balance between your interest rate and your origination fee. And some people would say that, look, if you're gonna do a very fast project, go for a lender that will give you a loan at a very high interest rate, but very low origination fees. Say that you're gonna complete your project in 1 week. Who cares what the interest rate is annualized if your points are like 0? But if you're gonna turn your project around in a week and you're still paying 2 points, well, it may not be worth it for a lower interest rate because you're not capitalizing on that time. Now when you get a hard money loan, they're gonna ask you for some documents about yourself. For the most part, they look at the property itself. Obviously, they wanna see the address and they wanna see neighboring comps. Their own underwriting team will probably do the comps for them, so don't worry too much about that. But you wanna be able to justify why you think this is a good deal to them, so they'll loan you the money in the first place. They wanna see if you have a credit score of about 630 or above. Under that, they're gonna start charging you more interest rate, more points, or they may not give you the loan at all. Make sure you have some kind of good credit history to really get these kind of loans. They're gonna wanna see, again, a scope of work. They wanna see what kind of work you're gonna do to the property with the actual numbers attached to it. So it's good to get a contractor to come take a look at the property and give you an accurate bid before you actually get a hard money loan. And they also wanna see a sheet of your experience. They wanna see if you have closed on different properties in the past. Is this your very first project? Don't lie, tell them the truth, but if you have more experience, let's say 10 projects or more in the past 2 years, they're gonna give you a significant discount because they trust you and they think you're able to do the project as you said you will. They're also gonna wanna see some bank statements from you, probably from the last 1 or 2 months, and that's just to show your liquidity. Liquidity meaning the money that you can use right away, whether it be stocks, bonds, mutual funds, or straight up cash. They don't want to see the money you have in real estate because you're not going to be able to sell your real estate and use that as cash right away. So they want to see liquidity of your down payment, construction costs, closing costs, and 6 months of your monthly payments. After you get all that wrapped up, they should be able to close in 10 to 15 business days, and they can probably go even faster for an emergency. By the way, shout out to Conventus Lending. They've been my #1 go-to source for all of my hard money loans here in the Bay Area. So if you guys have a project that you're looking into, click the link in the description below, ask for Brenda Chen, and let them know that Sean Pan sent you guys. So that was just a basic primer on everything you need to know about hard money loans. Check out the next video for more detailed information about real estate investing. Take care.